Okay. Good afternoon, everyone, and welcome to the G30's 38th Annual International Banking Seminar. It is a great honor that we are hosted here in Marrakesh by Governor Abdelatif Zari, from whom we will hear from in a moment. We would also like to thank the Managing Director of the IMF, Kristalina Georgieva, for the IMF's kind hospitality. This is the IMF's tent, one of their tents here, so thank you for the venue and for joining us in the second panel. I think we should begin by remembering the many Moroccans who were impacted both by the terrible recent earthquake and the ongoing recovery. The absolutely remarkable response of the Moroccan government and their exemplary, and I underscore exemplary, organization of these meetings are testaments that our response to tragedy can bring hope and also help set the stage for prosperity. Unfortunately, the world is currently plagued by many tragedies, including Russia's illegal invasion of Ukraine and the horrific terrorist attack in Israel. The world's being shaken, and we must draw on our common humanity to build just, inclusive, and prosperous societies. And this most fundamental challenge comes as the global economy is being redrawn. We're at a hinge moment of history sprung by a series of crises to finance, to health, climate, and geopolitics. And as that system, as the economy is rewired, as our energy systems are rewired, even intelligence, I guess, itself is being rewired, policymakers must reinforce the foundations of prosperity, and that's price stability, financial stability, sound fiscal policy, and sustainable growth. That's the backdrop for the conversation over the next 2 hours. It's a great honor to be joined by such distinguished speakers, and pleased to see so many governors, leaders in the private sector and academia, G30 supporters joining us this afternoon for what is, just to be clear, a public event. We'll be joined in a moment by the governor. We will have two panels. The first is on global economic and monetary challenges, and the second is on markets, governments, and a just transition. But it gives me a great pleasure to welcome Governor Abdelatif Zari, an absolute giant of central banking. He became a central banker back when I first joined an IMF meeting in 2003. He has seen it all, he's led it all. Il est la plus importante gouverneure de la francophonie, de l'Afrique, et en effet, du monde. His opening statement will be in French, so I give you the opportunity, if you wish, to join the simultaneous translation. Again, Governor, thank you so much for hosting us today. The floor is yours.
Merci, Marc.
Thank you, Mark. What you have said, I bring down to the friendship that unites us rather than what I represent here in my official capacity. Thank you for your kind words about Morocco. We very much appreciate the expressions of solidarity, compassion, and support that we have received on the part of the numerous individuals here present and countries and regions that they represent. There was a brief moment of suspension after the terrible earthquake, but I think maintaining these meetings is really the best example that the financial banking and international community was able to show to the Moroccan people and the Moroccan government. My thanks to you for that. Madam the Chair of the ECB, dear colleagues, governors of central banks, ladies and gentlemen, I'd like to begin by welcome you to Morocco and to tell you that for me it is a real honor and a genuine pleasure that the Morocco is welcoming such a prestigious gathering. As some of you may recall, I had the pleasure of hosting the G20 for its 63rd plenary assembly held in Rabat. And on that occasion, I had the honor of conveying a message of His Majesty Mohammed VI. I have no official message to convey this time, but I know His Majesty is always sensitive to your meetings and to what the G20 does. For that matter, during that year 2020, Mark Carney, who was at the time governor of the Bank of Canada and today chair of the group, and I won't underscore his considerable responsibilities on a global level in terms of climate, but he's very young, and so he welcomed us for the gathering of Francophone central bankers, and I'm delighted that he kept his promise to come to Marrakesh. He made me that promise a while back, but he's delivered on his promise. Ladies and gentlemen, I'm not going to really embark in my opening remarks on an in-depth assessment of the economic outlook. It remains very uncertain, and every time we think the situation is normalizing, a new crisis or shock occurs. We see what's happening very recently, the events around us. Having said that, I know that all of you here are following the situation very closely, and I'm sure that your insights are better than mine. But I would like to say that as a central bank, we're following very closely the work and the publications produced by your group. I can tell you that the quality of the papers, of the documents that you produce are extremely relevant for a country such as Morocco. And it's for that reason that I've seized the opportunity of this meeting to ask Mark to broaden to the framework of our banking system, to Moroccan academics and to Moroccan civil society faced with the complex challenges, the discussions of a forum such as yours can contribute to finding the best ways to rekindle international cooperation on a new basis and allow young people, especially those of our emerging and developing countries, to regain confidence in the future. I wish you an enjoyable here, and thank you for your kind attention.
Fantastic. Thank you again, Monsieur le Gouverneur, for your leadership and, again, your hospitality. We're going to get straight down to work because the opportunity cost of this audience and certainly this panel is very high. As I said earlier, it's a tremendous honor to be joined by the President of the European Central Bank and many other accomplishments, the Governor of the Bank of England, and Axel Weber, who we all know is a member of the G30, former President of the Deutsche Bundesbank, Chair of UBS, Chair of the IIF, and on and on and on to share some reflections. I'm going to call on Madame Lagarde first, followed by Governor Bailey, and then Axel, and there will be a few minutes at the end to take some questions at that point. So with that, Christine, please.
Monsieur le Gouverneur,
Governor of the Moroccan Central Bank, thank you so much for your welcome, and thank you for exercising the leadership that you show in your institution. We've had occasion to work together, and I know that in sorrows as well in joy, you always show equanimity and prepare to restore order and exemplary solidarity that you've shown us in difficult times. Thank you.
it's just lovely to be back again in one of these tents and to spend some time together and to respond to the invitation of the G30 under the leadership of Mark. It's a real pleasure being here. What I would like to do is to talk to you about moving parts, about mega shocks, and about mega trends. I think my grandchildren would be delighted because they keep using mega all the time. Everything is mega good, mega bad, mega this or that. And I think I regard it as my duty, and I hope our collective duty, is to make sure that things don't turn out to be too mega. But certainly they would be disappointed. So the global economic outlook as we see it is uniquely complex, as we have experienced 3 mega shocks, and I'll come back to those 3 mega shocks, that are still working their way through the economy, and at the same time, 3 mega trends, some of which pre-existed the pandemic, and 2 of which I will comment upon, and the third I will just drop for lack of time. And I'll leave you to wonder what those 3 mega shocks and 3 mega trends are, because what I would like to talk to you about is those moving parts. Because we policymakers, and especially those of us with the medium-term orientation, have to try and account for multiple moving parts. Now, what do I mean by moving parts? I'll mention 4 of them, and I'm sure that you can think about others. But the first one that I would mention is the unwinding of previous large shocks. The second that I would like to mention is the ongoing second-round effects from those shocks. The third one is the effect of strong but lagged policy responses. And the fourth one are the structural changes as larger trends take hold. Now, what do those moving parts have in common? Uncertainty, time lag, possible transformations. And the combined effect of the 4 is obviously highly uncertain. So in those circumstances, it will not surprise those of you who know me well that at this point in time, it's not a question of being hawkish or dovish. But it requires us at this point in time to be both patient as supply shocks reverse and new shocks arise, but not only patient, but also attentive to ensure that inflation expectations remain anchored while inflation is still too high. We're working on that. I'll come to that later. It also requires us to be careful as we assess the strength of our monetary policy transmission, but also alert to possible lasting changes in labor markets and potential output. So if you combine these 4, I would plead for the owl. So not hawkish, not dovish, but owlish. I'll do a bit of ornithology later on for those who are really interested. So let's turn first of all to the mega shocks that are working their way through the global economy. I would identify 3 mega shocks since 2020, which are still working their way through the economy. The first one, the pandemic, and its effects on the composition of spending and its effects on labor markets. The second shock is the unacceptable, unjustifiable Russian invasion of Ukraine and the effects that it has had on energy markets. And the third one, which might come as a bit of a surprise to some, is the macroeconomic policy response to these crises, which has involved globally centralized easing and tightening. Now, some might argue that it was a bit too late, could have started a bit earlier. Suffice to say at this point in time that it did happen, and it was surprisingly strong and surprisingly synchronized up to a point. The legacies of these shocks are visible in the global outlook, where we see headline inflation easing, but core inflation still high. And we see weak growth and yet incredibly strong labor markets. I will skip for you the OECD numbers, and I will concentrate on facts and figures concerning the euro area, which is the part of the world that I know best at the moment. So in the euro area, inflation has fallen by more than half since its peak last year. Past inflation is still feeding through into domestic price pressures. Most measures of underlying inflation, which is one of the three key components that we look at to determine our monetary policy stance, so those measures of underlying inflation are starting to fall, but progress will take time. And I say starting to fall with some trepidation because it is the beginning. Core inflation is projected to be at 5.1 in 2023, 2.9 in 2024, and of course, much closer to 2 in 2025. Wage growth, which is particularly important in that context, remains strong. Compensation per employee in the euro area grew at 5.5% in Q2, and forward-looking wage trackers, some of which we had to invent actually at the ECB and within the whole euro system, which are participating in this endeavor and whose governors are, for many of us present in this room today. But these wage trackers do not yet give clear signals about a turning point in wage growth. We're just seeing the little trepidation of that going in the right direction, but it's not sufficient to be absolutely confident that it is going down. At the same time, growth is weakening owing to the effects of past high inflation on real income and the growing strength of monetary policy transmission. We have hiked interest rates by no less than 450 basis points, starting from negative 0.5, moving to 4% as our DFR, which is the most commonly used rate in the context of what we are living through at the moment. Consumer spending, which we will count on, is softening. On average, retail spending in the euro area in July and August stood 0.6% below its average level in Q2. Higher policy rates are passing through to lending rates, and they're passing through particularly efficiently, unlike what we had seen in previous similar episodes, although none of those episodes are similar, are they? But they're passing through to lending rates, which is obviously weighing on capital-intensive production, especially manufacturing. In addition, the service sector, predominant in our economies, the service sector is now starting not to catch up with manufacturing, but to catch down with manufacturing, as pent-up demand for travel and leisure fades and as spillovers from industry strengthen. However, and this is very incongruous and fascinating to observe, and I'm sure to study, and the academics in the room, I hope, will spend a bit of time on that. The labor market still shows no real sign of weakening. with continued falls in number of unemployed persons and increases in the size of the labor forces. Now, some observers who are typically more pessimistic will say, well, this is the rear mirror view. We are already seeing signs that actually labor is going down. The number of vacancies is less than it was 6 months ago, and just wait, it's going to get worse. Might be, but for the moment, the numbers we see both in terms of actual participation in the employment and unemployment in nominal numbers are quite striking. The unemployment rate was broadly stable in August at 6.4%, and the number of unemployed decreased by almost 106,000 people month over month, while the labor force increased at the same time by 100,000. And in that context, monetary policy has to strike a balance between, number one, reflecting the improving medium-term inflation outlook. This is one of the 3 criteria that we use as well to determine our stance. All that given the ongoing unwinding of supply shocks, decelerating underlying inflation, and weakening growth, and avoiding declaring victory too early, given the long way that we still have to go and the high uncertainty, especially as our projections are premised on developments that have not yet materialized. For example, and that's an important, not caveat, but an important point, a key assumption that we make in our baseline and our scenario analysis is that continued wage increases will be absorbed by firms in their profits, which we are only just about to begin to see. So 2022 was not a year where salary increase, albeit smaller than what could have been expected given the lag time, could have been absorbed in the margins of corporates and employers. It wasn't. We are beginning to see that in the second quarter of 2023, and we hope to see a continued trend, which would be logical to the extent that we are dampening demand, and as a result, corporates should not be able to pass through the cost of increased labor wages into prices going forward. But this is something to which we are particularly attentive, of course. And that is why, to reinforce progress towards our medium-term target, the ECB decided to raise rates again at our last meeting. But we also said that based on current data, that is our baseline, we consider rates have reached levels that will, and I call your attention to that for those of you who are interested in our very, very colloquial English, will make a substantial contribution to a timely return of inflation to our target. In any case, our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to return inflation sustainably to 2%. So that really has taken care of my 3 mega shocks and the consequences that we draw for monetary policy. Now, I'm going to mention 2 mega trends. The third one is debt, but debt would require an entire special session, and I will skip that one. But the 2 mega trends that I would like to talk about, because we have some recent data and some recent development in that respect. The first one is deglobalization, otherwise called, if you listen to Ngozi, the head of WTO, re-globalization. That's the optimistic scenario. I would prefer to use deglobalization. The second one is demographics, which in our part of the world matters significantly. So, first, we are now beginning to see signs of deglobalization in the sense of the global economy fragmenting into blocks. And this is likely to lower global growth in all scenarios. Deglobalization is not yet visible in aggregate trade flows. Even between China and the US imports from China in 2022 are still over 30% higher than in 2017. And we tend to sort of glorify those numbers and keep repeating that there is politics somewhere and then there is economics and trade somewhere else. We have just recently surveyed 65 large European corporates that have subsidiaries, branches, networks, and certainly supply chains all over the world. And the number of them that are now saying, I am actually looking at reshoring, getting closer to base, moving my facilities and my people, more importantly, out of the places where we were invested is actually growing significantly. They're not just about doing it, because for the moment they tend to say, well, China plus one, but the move towards this reglobalization or deglobalization is actually intended by many of them. To give you an example of how trade patterns, for instance, investment patterns are changing, the share of FDI taking place among geopolitically aligned countries has been increasing over time from about 40% between 2003 and 2010 to more than 50% in 2021. That's an important change in a very short period of time. There have been a number of studies recently that quantify the cost of sudden and severe fragmentation, and they all come out with high numbers. The IMF has done a very good study of it and came out with very frightening numbers. Our research at the ECB finds that in a scenario where world trade fragments along geopolitical lines, real imports could decline by up to 30% globally. And in such a scenario, the losses for the euro area are estimated to be more than twice as much as the losses for the US and China. They are worse than the euro area, but I'll spare you their list. But even in gradual fragmentation scenario, we're likely to see higher cost and lower knowledge spillovers, all of which mean slower global growth. Second, rapidly, is demographics. We will soon see developments in the labor markets that also will have a significant impact on growth and significant impact on the availability of labor and the elasticity of labor. Labor markets at the moment, wherever you look, in the OECD and certainly in the euro area, those labor markets are currently historically tight everywhere, and partly due to specific factors, pandemic-related mismatches, cyclical factors, strong recovery, etc. But the effects of demographics, shrinking working age population, will soon start to add to this, in particular through the retirement of skilled workers. Over the coming decades, the working age population is projected to fall by 25 to 35% in many OECD countries, and the euro area countries do not escape that. So much so that we will see a continuous decline in those aged 15 to 64, defined as the working age, starting already in 2025 and continuing onwards. However, whether all this ultimately leads to tighter labor market will also depend on what happens with two factors. One that I will not comment upon, which is immigration and how we address and deal with immigration. And the second, which is far more discussed and less politically charged, I suppose, is the role that generative artificial intelligence will play in replacing some of those skilled or not so skilled jobs that will eventually be affected, or for some of them will disappear. According to the OECD analysis on this topic, more than a quarter of jobs in advanced economies rely on skills that could easily be automated. But ECB research finds that over the last decade, employment shares in Europe have increased in those occupations most exposed to AI. So there is transformation coming up. And under the combined effects of those mega trends, certainly we will have to think long and hard about the consequences that it has for multiple factors, but I'm sure that we will be, one of these days, soon enough, be looking at the stars. Thank you.
Brilliant. Thank you very much, Madame Lagarde. I've always wanted to say this. Pray silence for the Governor of the Bank of England.
Thank you, Mark. Can I join Christine in thanking you, Mr. Governor, for your tremendous hospitality, but can I also thank the people of Morocco? It has just been the most enjoyable week, and they have made it so good to be here. And we owe you all a huge debt of thanks, particularly given what you've been through. So I'm going to pick up on Christine's themes and develop them a little bit. I'm actually going to start with an unpopular, in some quarters even rude word, and that's transient. But I'm going to take it on because I think it has to be taken on, actually. It's the word we don't say anymore, but I think it's a good place to start. And what does it mean? Well, it means, in an established sense, a single supply shock, the length of which may not be any longer than the monetary transmission mechanism, and then the question is, how do you respond to it? Where can it go wrong? Because clearly, there's been a lot of discussion of how it did go wrong as a piece of analysis. And I would highlight one area where it went wrong and one area that we may face going forward. So the area where I think it went wrong is that we've had a sequence of shocks. And this is the point that Christine made. A sequence of very big external supply shocks. And there was no air gap between them, really. And so the idea of transience in terms of limited time, of course, therefore, phrased very badly. Because clearly the public at large can see that this is not actually going away within the sort of time frame that they would expect, and it's not going away within the monetary transmission time frame. Unfortunately, we learned that over time. The second thing, and this is the point that we are, in a sense, we have to be very alert to, I think. The second way it can be difficult is where a subsequent shock lands on a system that is adjusting, but a system that hasn't fully adjusted. And what I mean by that is, inflation is not back stably to target. And I say that because we have to watch very carefully, obviously, the very difficult events that have happened and are happening around us, and you have the capacity, particularly, to affect, for instance, energy markets. Putting that into context of where we are, it means that, of course, monetary policy now has to be restrictive and has to be, in a sense, demonstrated to be restrictive, and we have to be convinced that it is. My own assessment, the Bank of England Monetary Policy Committee's assessment is that currently monetary policy in the UK is restrictive in the sense that we can see it restricting activity, we can see it having an effect on the quantity side of the labour market, and we can see it having an effect in the housing market. I should say what is more puzzling, and in a sense we wait to see, is the situation on pay and earnings, where it isn't. The usual effects and the usual transmission mechanism is not yet being demonstrated. But that point about policy being restrictive is an important backdrop to the decisions that we've had to take and the decision that we took at our last meeting to hold policy. The other point I would add is that, of course, the other factor here in judging policy and in judging restriction is the transmission mechanism of policy, how that affects. And certainly in our case, we're facing a changed transmission mechanism in one very important respect since the last phase of raising interest rates, which was before the financial crisis. And that is that we've got a different mortgage market. We've moved from having a predominantly variable rate mortgage market to a predominantly fixed rate mortgage market, but I should say not a long-term fixed rate mortgage market, a fixed rate mortgage market that revolves around 5 years, give or take. But of course that leaves us with difficult judgments about how quickly policy changes come through, with what force they come through, how much the public is anticipating the effects of those policy changes to come, particularly when you've got a fixed rate mortgage that the date at which it is going to actually be refixed. So those are all judgments that we're having to make and we'll have to go on making. Put those together, my own view was that we had certainly reached a point where, with restriction being evident, that it was sensible to hold policy so that we could observe the effects of those things happening. But there's another element to this, and that is what we might call higher for longer. What is the effect of holding rates higher for longer and giving a clear message that that is the best judgment we have at the moment of where we think rates will be? Now that's important because I also divide the, if you like, the bringing down of inflation job in the UK into two parts. We're still in the first half, in the sense that we've had some quite good news on inflation recently. It's not only coming down, but somewhat undershot some of our short-term forecasts. A lot of that is the unwinding of what happened last year, and there's more of that to come. But to borrow a phrase from the BIS, the last mile is going to be the hardest. That's the second part, where of course policy is doing the work at the moment, because the unwinding of those shocks will have happened by then. And those again are the difficult judgments that we have to make. Now it's interesting to look back 3 weeks to our last decision, because at the time I was very concerned that the communication of that decision conveyed the sense that we were holding, but we were holding with a view that we would be there for some time while we watched the evidence. We were not ruling out that we may have to move policy up again, because again, it would depend on the evidence. But I was concerned that decision might give the sense that we would be moving towards loosening policy more quickly than had been anticipated. I suppose with the elapsing of the last 3 weeks, I'm not sure why I was quite so bothered about that, given what's happened since, but it was very much the judgment and the concern we had at the time. And I say that because it remains the concern. It remains important that we convey that message. So in the rest of my time, I want to cover just 2 points quite quickly, because some of the next point Christine has also covered, and it's important. Potential growth on the supply side. Again, just to take the UK as an example, for much of my career, we talked about and thought about the potential growth rate of the economy as being around 2.25. Governments would come in and want to get it to 2.5. They might get it to 2.5. So that 2.25 to 2.5% range was a good sort of estimate, and it was a pretty good description actually. Today, I'm afraid it's at best 1 to 1.5 at best, and that, of course, complicates the job of monetary policy. But it also complicates other things as well. And when you break it down, there are 2 key points. Christine rightly highlighted the question of labour supply. We see this particularly in the UK because there has been a withdrawal of labour supply. Participation in the economy fell during the COVID period, and in the UK hasn't come back as fast as elsewhere. And I must say, I sit today and think that the lasting effect that I judge so far from COVID is that I think it has changed people's attitudes towards the way in which they participate in the labour market, and we have to come to terms with that and understand its implications. The second aspect of the potential growth story is productivity and investment. Productivity in the UK since the financial crisis has been weak. I mean, it is stark to compare productivity growth before the financial crisis in the UK and afterwards. My own view is that this highlights something that we've discussed a number of times this week. It gets to the question of debt. It gets to the question of expectations of the role of the public sector. And I think it gets to the question of how we stimulate private sector investment. And I think there is a role here for financial policy more generally, because there are big challenges. Mark is taking on one of these huge challenges with financing climate change. I think there is an important focus that we need to have on this, because it will support investment and productivity growth. And certainly in our case in the UK, I think an important part of that is ensuring that our pension industry can play its part in investing in private sector assets. Now, not in a way that is inconsistent with risk management, because it would be a bit odd, because this time last year I was standing here or in another room in Washington at this same conference having to talk about the consequences of risk management in the UK pension industry having gone badly wrong. But I still say that there is an important role in supporting private investment. Let me finish just with a couple of words on financial stability, because it is important and it doesn't get enough attention. And I'll say 2 things. And both of these I'm going to say as compliments to Mark, actually, because we are seeing the benefits of financial stability actions that certainly we took in our Financial Policy Committee. First of all, in terms of the household sector and mortgage debt. We have both an affordability test and a limit on the share of lending that can be done at high loan-to-income ratios. They're not always popular. In fact, they're not ever popular sometimes. But I do think that the fact that we have got a less exposed sector, a less exposed debt position, has some relationship to those measures. The second one is in the banking sector. Again, I think we have a well-capitalized banking sector. I always say, the good thing about the last 3 years is that the banking sector has supported the economy, not the other way around. And part of that is financial stability tools. Part of it is the counter-cyclical capital buffer. I'm sometimes seen to sort of bewail the fact that it doesn't get more attention, but then people point out to me, you don't seriously expect people to be discussing the CCYB at their dinner tables, do you? And probably not. But what I will say is that we've just published our latest decision on the CCYB to hold it at 2%. And what we had to go through was, yes, there is a tightening of credit conditions. Is that tightening due to sensible risk management by banks, or is it due to restrictions on the ability of the banks themselves to support the economy? Our judgment is it's the former, but it's a much better place to be able to have that discussion and reach that decision. So there are some, I think, positive aspects of where we are today. Thank you.
Thank you, Andrew. Axel Weber.
Well, thank you, and let me echo the remarks of previous speakers. Really thank the Governor for hosting us here, the Group of 30 today, and the people of Morocco for hosting these meetings. It was the right decision to come, and I've enjoyed tremendously being in the country, so thank you. Since I'm no longer a central banker or a corporate leader, and I'm stepping in for Augustin Carsten, just to make that clear, I thought I would talk a bit about how I, as a consumer of central bank policies and financial decisions in the corporate and banking sector, look at the news of what I see today. And let me start, which I think is important, to take a sort of 10-year view. Having been in financial markets, the ultra-low interest rate environment and quantitative easing, in my view, have been the main drivers of equity booms over the last decade or more. When I talked to our people in the bank, and I was told how fantastic investment strategies everyone was following, my point was always this was not possible without the central banks injecting massive liquidity and putting interest rates at the lower bound. What then happened was, after the pandemic, central banks stepped in, and the initial reaction, both of fiscal and monetary policy, to really strongly lean against the wind and expand fiscal policy by 25% of GDP globally, and the balance sheet of central banks equally, was the right reaction to the crisis. But I think it lasted very long, and the flip side of letting the economy run hot was actually, in my view, allowing inflation to run hot. With a temporary hot economy at full employment, the perception that there would only be a temporary rise in inflation turned out to be too optimistic. Double-digit inflation has increased the risk of second-round effects, and it also has increased the risk of unanchoring inflation expectations. And you hear it from both of the governors. That's exactly their analysis. Whilst monetary policy is starting raising rates late, it has started to do that in an unprecedented determination. They've raised interest rates sizably, quickly, and in a very synchronized global fashion. The flip side now of doing that is cooling inflation down will not come without cooling the economy down. And you cannot have a cooler economy and trying to achieve that at full employment or employment at current levels. And again, both referred to the labor market that hasn't really turned. It will, but it will take time. The primary task of monetary policy now, in my reading of the news, is to credibly reestablish the 2% inflation target by achieving it over the policy-relevant horizon. And only this will credibly re-anchor inflation expectations at 2%, and only this will eliminate any risk of second-round effects in wage and price dynamics. And this is exactly what I hear from the central banks. But when I look at the news, this doesn't seem to be the news journalists are getting, or when I listen to my friends in financial markets, it doesn't seem to be the news they're getting, and I wonder why. It seems a bit like some of that clear messages from the central banks get lost in translation. Monetary policy, in my view, has now largely finished its rate hiking cycle. But even if now there is a more balanced assessment of risks, with more downside risk to inflation and upside risk to unemployment, and we are in a situation of heightened uncertainty due to the increased geopolitical risks, this does not rule out further adjustments in interest rates in principle, largely because whilst the direction is right, we still have a resilient labor market and inflation is still too high. And you really need to think about this in terms of direction and level. The direction is right, the level is not. As monetary policy again becomes more data dependent, I think you will see in the December forecast that there is a good guide on how this may play out. But in any case, interest rates will stay, and that's a message I also hear very clear, high at current higher levels. The broad-based market perception seems to be that this is only a transitory rise and rates are likely to come down. I think this will turn out to be too optimistic, and in my view, it is in particular unwarranted given that the high for longer interest rates will only have noticeable delayed impacts on the economy because we know from monetary policy that monetary policy has long and variable lags. This will impact on the business cycle. This will impact on financial vulnerabilities, in particular where risks have been taken that were excessive relative to what should have been taken. And in particular, this will happen after the fastest, steepest, and most synchronized rate hike cycle the globe has seen so far in post-war history. For the US markets are pricing in 50 basis point reduction by this time next year. I have no idea where that comes from or how you would justify that. And I'm pretty sure that that's not going to happen. In addition to having raised interest rates, monetary policy has continued to implement an orderly reduction of the balance sheet. So in a way, there is a double policy tool. The structural reduction of central bank liquidity, which will happen in a completely uneventful way, almost deterministically, with a fixed number every year, is going to nevertheless turn what was tailwinds for the market in terms of liquidity, and actually the massive injections of liquidity, it was liquidity when it was needed at zero rates all the time. Now what we're facing with the reduction is less liquidity at higher costs, and in particular much higher costs where it's very much needed. Risky assets are becoming less attractive. The return on safer assets is becoming more attractive. Actually, if you look at where we are at the current juncture, the bond market is already very attractive. If I look at the S&P 500 dividend yield relative to 10-year treasuries, the stock market returns are way below that. Even for Germany, the DAX dividend yield is below the 10-year Bund. We're moving from a world where higher rates will squeeze profit margins for non-financial corporates, on average, after a 400 basis point rate hike by 4 to 6 percentage points. So profit margins of firms will turn, and this is not yet in the corporate reporting. A major equity market correction, in my view, cannot be completely ruled out. If you look at where we're going on the bond market, a good bond market performance typically only arises when interest rates have peaked. Therefore, when you can lock in maturity, when the next likelihood of a rate move is a move down, and that's exactly where we stand now. We're starting to see the market shift into longer rates. There will be continued portfolio shifts into fixed income assets because equity is less attractive. There will be accelerated shifts from shorter to longer maturities in the fixed income world, and there will be selling pressure at the short end. The financial market is just about getting that on the menu. It's not yet on the table, and it's not yet something that you will see in the data. Monetary policy transmission will kick back very strongly through all 4 channels of monetary policy transmission, through the interest rate channel, which was not functioning with rates at zero, through the exchange rate channel, which didn't occur under synchronized monetary policy, and through the portfolio channel, which was not working when the only game in town was equities and fixed income was unattractive. The only thing that did work was the wealth channel by basically equity markets booming, and that's likely to get reversed. So, in my view, you're going to see some more volatility out there, and it's going to play out. Bank funding is going to come under stress in 3 important areas. The first one, we will shift from low-yielding bank deposits into higher-yielding assets on banks' balance sheet. Money market funds, term deposits, all of that. Actually, the current tailwinds that the banks currently report this week, starting with the US banks and the European banks to follow, on what they call NII, net interest income, is a revenue reporting that will be squeezed. My point about NII is enjoy it whilst it lasts, because it won't last. It won't last because it will get squeezed from central banks now remunerating deposits, in the case of the ECB, at 4%, and being really astonished that bank deposits get remunerated at a rate that is just a fraction of that. And so banks will increasingly find themselves squeezed from central banks trying to stop that, talking about minimum reserve requirements, and consumers not having it any longer. Consumers now have choices, and what you see in the uninsured part of deposits on banks' balance sheets is they're now much more price sensitive, and they're much more risk sensitive to counterparty risk. If you look at the wealth management bank runs, which is what I call it, because it was bank runs at Credit Suisse, which at the core had a major wealth management deposit base, at Silicon Valley Bank, which is also the closest proxy for a US wealth management bank, and at First Republic Bank, which again had a jumbo mortgage problem because they have jumbo mortgage clients, so it's a wealth management bank. What we've seen also is much more sensitivity in the insured deposit base, because now counterparty risk, even if it's insured, is an additional risk you may not want to take, and new ways of digital banking will absolutely accelerate the runnability of deposits, not just in wholesale space and above the insured limit, but also in retail space, because why bother being part of a workout process if you can avoid it to moving somewhere else? So I do think we are moving into a very difficult point in time. And let me finish on 2 reflections. First, banks are, at the moment, in my view, doing what they always do. They're moving assets from mark-to-market to hold-to-maturity and are insuring them against mark-to-market losses, in which case you're betting everything on an asset not defaulting, and when it defaults, there's a jump to 0, where basically you have to write the entire thing off rather than adjust its pricing over time. And the second problem that we're seeing in the market is there's a huge amount of action now happening, because basically with higher interest rates, the prices for bonds, for credit, for all of your investment portfolio get depressed. And that's something that will work its way through the banking books for some time. There's a non-bank financial intermediation that is a new risk, but it's a regulatory terra incognito for most of the banks and regulators. We'll see how stable that is. My question would be, is it systemic? And last not least, my biggest concern is all the areas that didn't suffer any problems in the last financial crisis. Complacency only breeds where there is no problems. And if I look at the areas where there was a big impact from the last financial crisis, those areas that are suffering and likely to suffer in the future are in particular, again, housing markets in those economies and sectors that didn't have a problem last time around. Commercial real estate is the problem now, as opposed to real estate or mortgages in the last time around. Mortgage markets in New Zealand, Sweden, Canada, Australia, the Netherlands have really been largely spared last time around. Look at the decline in prices there. So I go by this symptom: if it wasn't a problem last time, it's likely to become a problem now. And with that, keep your safety belts on, because trying to land this plane safely is required that you go through rocky air. Thanks for your attention.
Thank you. Fantastic. I'd like to begin. I'm going to come to the audience for questions. We have about 15 minutes, so if you raise your hand, we have roving mics who will find you. I want to take a moment to thank the panel for an exceptionally rich set of observations that blend medium-term structural, as Christine said, shocks and trends, with touching on the conjuncture, but really on the underlying frameworks, both in monetary and financial stability, and capturing those elements. So there's a very rich theme that you could touch on. And I'll start at the front row. Governor Ortiz, Guillermo Ortiz, who, for those with the mic, is just standing here.
As we all know, this time around, emerging markets started raising rates much earlier than the main central banks. In fact, the Central Bank of Brazil started raising rates in May of 2021, almost a year before the Fed did. And it was followed by Mexico, Colombia, and so on. So this is a conceptual question. Had the major central banks read accurately, or more accurately, this transient or non-transient component, if the cycle had been spread over 2 years instead of 1 year, as Axel pointed out, this is a historic period in the sense that this really high interest, this very rapid interest are compressed in one year time. So the question is, suppose you had spread this for 2 years. What about the transmission mechanism? And would the need to hold rates for higher and longer would be different?
Okay, I'm looking for volunteers for that question. It's a good question. Governor.
Oh, right. Well, I get asked this question quite often, and I have to say I always do begin with the point that we don't set policy with hindsight. What I think is important, certainly, and I judge it by our case, is that we were not at that time facing what I would call, very strong growth and demand in the economy, and the subsequent sort of history, the subsequent sort of, in a sense, revealing of the story has borne that out. I mean, the economy was, frankly, for a long time struggling to recover the level of demand we had pre-COVID. It really was a question of the supply shocks. And, let's put it to one side, none of us, I think, at that point could have predicted, sadly, the Ukraine war. The real question for us was actually what I call the domestic shock, which was the labor market. And here I think there is an interesting question. I mean, there were very strong policy measures taken during the COVID period to support people during the disruption of the labor market. We had a furlough scheme. Remembering back, I mean, that was done to support people, but also to enable social distancing. Now, the judgment we had to make was this scheme came to an end at the end of September 2021. Right up to the last day, 1 million jobs were in that scheme. What was going to happen when it ended? And it comes back to the point I made earlier about, I think, one of the most difficult, in a sense, judgments, but also, in a sense, fundamental changes that we've seen with COVID is people's attitudes to participation in the labor market. Almost all economic forecasters, us included, were assuming that there would be a level of dislocation when this happened, when, in a sense, the COVID blanket was taken off, that would lead to quite a substantial increase in unemployment, and it just didn't happen. Interesting. And we were wrong on that. I mean, we were wrong on that. Now, I think your question is a good one, but I think if you look at the sort of say, well, okay, let's say we'd known that and we'd increased interest rates ahead of a supply shock, we would have still been facing the transient question, which is, how long was this going to last for? What were the effects going to be? And I say, I'm going to put on one side that we could predict the next supply shock and the big one, which was Ukraine.
Yeah, thank you so much. When I was thinking about your question, I thought of two moments, actually. The first moment is when the governor of the Central Bank of Brazil, probably 6 months into his job of hiking rates, and we were debating, particularly within the BIS, the transitory, non-transitory, transient, non-transient aspect of the price movements that we were seeing, and where some of us were considering the non-transitory aspect of it, and sort of impressed with the high succession that he had decided back at home. And he said to us, he said, "Welcome to the club." And I think it goes to the point of the fact that we are creatures of habits. And for 10 years, certainly in our part of the world, we had seen too low for too long, both in terms of inflation and low for long, certainly in terms of interest rates as well. Whereas in Brazil and in many other emerging market economies, there had been a habit of very brutal inflation crisis, followed by very decisive determination to bring it down. This is not something that we were used to, for sure, and I think it played a role. Now, for the record, I would also like to say that, contrary to what is often said, that the ECB really started taking stock of that and decided to change its policy. We did start hiking rates in July, but we started announcing the change of policy in December 21. And just by flagging that we were going to let the asset purchase program run off and not reinvest anymore, and moving forward guidance forward, I guess, we almost immediately increased the interest rates by 200 basis points. So it's just something that many observers tend to forget, and I would just to remind all about that.
If I can just add one or two sentences, Mark. So I think emerging markets exactly fall in the category. They got burned so many times, they learned the lesson early, so they moved. And I think that was the right thing to do, but it took some crisis for them to learn that lesson, that better than repairing capital outflows is preventing them. And that's why we haven't seen these capital flow reversals. On the central banks in the established world, look, it wasn't late recognition, they took an insurance policy. The economy was suffering badly, and they took an insurance policy, and because of that insurance policy, they reacted later because, the word that I used was letting the economy run hot. And the risk was a calculated risk because inflation was subdued in all the years before. It just came back with a vengeance. So they took a calculated risk. It turned out to be wrong, but we shouldn't do Monday morning quarterbacking. We should look ahead and say, so what is it we need to do now where we stand? And I think on that one, I give them 5 out of 5 because they're doing exactly what is needed now.
It's interesting. I'm going to take 2 questions and then give the panel a chance to respond, but I'll just make a comment around this because I was reflecting when both of you were talking about the transmission mechanism and how it may have changed. I mean, the adage, wisdom comes from experience comes from mistakes. And of course, you have, in the history of financial challenges, unfortunately, in a number of emerging economies, the wisdom that's accumulated from the past. The challenge that the sitting policymakers have, particularly in advanced economies, both of you touched on it, is quite a different structure of a financial system from when the last time rates were moved. So you can do the calculations, but you also have to do the calculation or the estimation, have the wisdom to judge the response of the financial institutions and of the borrowers themselves. So there is a very large human element for which you don't have a track record to make the judgment. And that's part, I thought you, Christine, you set it up very well at the start with the, as you laid out the framework. Okay. Valentino Ross, and if you may ask a question, then hand the mic to Tobias Adrian right after, and we'll take 2 and I'll let the panel address them.
Thank you, Brunello Rosa. The buzzword of these meetings hasn't been higher for longer or high for longer for central banks. My question is, what would be the financial stability implications of keeping rates higher for longer? Thank you very much.
Speaking of financial stability, yeah.
Just quickly, you're thinking around the rise in long-term bond yields, how that interacts with monetary policy. It may reflect balance sheet expectations about balance sheet normalization, as well as shifts in the assessment on longer-term fiscal positions.
Excellent. Okay, maybe I'll, Axel, if you don't mind, can I go in reverse order here and start with you?
I think absolutely. Look, after every major rate hike, we've seen fractional problems in the financial markets and financial stability, and we've seen knock-on effects for the business cycle and conjunctures. Every chart you draw over 40 years has gray zones in for recessions and financial stability crises, and it's sort of not a necessary but a possible outcome of a major adjustment in rates. And as I just said, short, sharp, and synchronized is likely to increase the probability of problems in the financial sector. Are we good equipped for dealing with that? Well, in different pockets of the market to a different degree. I haven't mentioned leveraged loan, high yield credit. I haven't mentioned collateralized loan obligations in particular originated in elements of the markets that are less controlled than the banking system. So there are pockets of weakness out there that we need to watch. But I think what we need to watch is that we don't fall into the same trap as with the great financial crisis, that basically there is contagion. And when I look at contagion risk, the biggest achievement has been that contagion through the banking system is eliminated by the interbank market is now completely differently organized. There are new risks on run of deposits. So I think the system as a whole, in particular for the major banks, is very stable. In the shadow of major banks in the US, the mid-sized banking market had exactly that phenomenon that I tried to describe. There was no lessons learned from the last crisis. Behavior continued because they weren't hit, and fragilities increased under the radar screen. And then suddenly everyone was surprised how a bank can mismanage interest rate risk in the banking book. That's sort of banking 101. Still, it happens. And that's what we need to be prepared for. Things happen. And we need to be able to react. But I think we've seen the strongest coordinated reactions among central banks and regulators in any financial crisis this time around. So I'm not negative, I'm just cautious.
Very good. I think you referenced wealth management banks that had a run. You can see why the world's largest wealth management bank that didn't have a run, because Axel was chair and he has the focus on what can go wrong. Andrew, maybe I'll ask you to respond and any last words.
I mean, two things. I actually want to go back to something Axel said earlier on, which I think is very important. Axel pointed rightly to the thing we have to watch out for, that there is not more hold to maturity activity going on within banks. Now, I look at the UK system, and we've stress tested it repeatedly, and I think it's in sound shape. But I think we have to watch out for a couple of effects from this hold to maturity thing. One is, I think having hold to maturity assets in the liquidity buffer presents particular issues. Secondly, I think the general question of having hold to maturity assets, where you've then got, to use I think a European phrase, a negative fair value adjustment, severely restricts what you can do in terms of restructuring the institution if you need to do that. Second point I'm going to make is on the non-bank sector, because it's very clear over recent years that we've had to relatively shift our attention towards the non-bank sector, and that's appropriate because the scale of intermediation that now goes on through the non-bank sector has increased relative to the bank sector in the post-financial crisis world. And I'll make an observation that I make quite often. This is a huge landscape. So the landscape of non-bank financial intermediation is huge. It's very diverse. And one of the things that I think we've experienced so far is that the problems can sometimes crop up in some of the more obscure or smaller places. And that sets us what I call the breadth and depth challenge as to how we go about monitoring this very big landscape. Because just finally to illustrate that, going back to the issue that I was having to deal with exactly a year ago in the pension sector, it illustrates the depth of the problem of slightly obscure places. That pension sector was basically an 85-15 split between big pension funds that had their own sub-fund that did this particular thing, smaller pension funds, 15% of it, pooled their activity with others. It was the 15% that blew it up. So you could spend your time looking at the 85%. We spent quite a bit of time together thinking about this. And you were looking in the wrong place, it turned out. And that's an illustration of you've got this huge landscape, and small bits of it can do quite a lot of damage. So we have to get our heads around and how we deal with that, and how we assess it and monitor it.
Excellent. Christine?
Yeah, thank you. On the first question that one of you asked over there, financial stability. Well, it was you. Financial stability, price stability, number one, are not mutually exclusive, and one is a condition to the other. But in the present circumstances, there's no trade-off between the two. Now, once I've said that, I would like to just point out that in the euro area in particular, there's a combination of much stronger banking sector with capital ratios north of 14%, with liquidity coverage ratio which is north of 150%, which makes our whole system much stronger. Is that to say that all banks are totally covered and that everything is safe? No. But I would also observe that supervision has been much more intrusive, much more, I would say, efficient, and in particular the extensive use of the fit and proper assessment has, in my view, led to governance in particular that is probably more conducive to a solid risk-taking by some of these institutions. And third observation, tribute to Mark and to Andrew and to others who worked really hard on that. We have macroprudential tools and buffers that have been set in place that are intended to at least anticipate and possibly prevent the risk of financial instability that would be detrimental to the price stability that we pursue as central bank. And fourth observation, final one, is that we are very attentive not just to monetary policy and its impact, but to the transmission of monetary policy. And if we were to see that the transmission of monetary policy could be impaired and could lead to disorderly market circumstances, we certainly have the tools to address the issue. Thank you.
Excellent. Well, thank you very much, Christine, Andrew, Axel. Exceptional panel. I will make a point to the audience that there is a bonus for this panel in that the governor of the Bank of Israel was due to attend for obvious reasons. Governor Yaron has not attended, but he prepared his remarks for this panel, which have been released with the timing of this, so you will find them online. But a very rich discussion. Please join me in thanking our panelists. Okay, we'll just do a quick change of names, change of water, addition of individuals, and appreciation to all of you. That's good. She's going there. I'm here. So if I may invite Governor Kanyahu Lesetcha, my friend. How are you? Good. I'm very well. Very well. It's good to see you. And the managing director, our host, our other host, who's coming up. So, Kristalina, if I may give you the floor straight away, if you would like. Yeah? Well, everyone's here. Everyone wants to hear. How are you?
Very well, very well.
So just as the managing director is getting set, we're going to talk about aspects of markets, government, and just transition. That is an enormous topic. But the responsibilities of the managing director of the International Monetary Fund are enormous. And we're very grateful, Kristalina, that you discharge them with such skill, alacrity, energy, focus, and impact. So with that, I give you the floor.
Well, thank you. Thank you very much, Mark. Indeed, these have been very effective meetings in a very difficult context. And it comes without saying that one of the reasons we have had successful meetings is the incredible host, the Moroccan authorities, the conditions you have created for all of us here. So thank you very much. I am. I have people coming to me and saying, very vibrant meetings, very upbeat in terms of how people engage, and fantastic conditions. So thank you. But I want to start with the complex time we are in and draw some conclusions for what lies ahead of us. You heard from the previous panel, and you have heard it throughout the week. Yes, the recovery from the shocks of the last years continues, but it is slow, it is uneven, and risks are still quite prominent. The fact that now there is a war with innocent civilians in Israel dying, and now efforts to prevent humanitarian disaster in Gaza ongoing. This certainly is yet another source of anxiety for the world economy. I want to concentrate on the message that came from the previous panel, and it is we are in a period of time when monetary policy would stay tighter for longer. There has been already withdrawal of monetary accommodation, and the result of higher interest rates do translate into higher risks for fiscal policy. So we are going to be concentrating much more on the trade-offs on the fiscal side, because over the last years, governments, and for that matter, also companies, accumulated more debt. With higher debt service costs, this is a bigger burden on budgets. And at the same time, there is a continuous pressure to support vulnerable parts of the population. And we see now concern about energy prices again popping up, concern about how this may translate into food prices increasing. We know that El Niño this year is going to hit some of the agricultural producers negatively. And then we have the incredible importance of the green transition, without which, to put it very bluntly, we are cooked. We can survive inflation, it's bad, but we are not going to be extinct as a result. We can survive a recession, again, not good. What we cannot survive is unmitigated climate crisis. And that mitigation, as well as adaptation and transition for countries dependent on fossil fuels today or industry related to fossil fuels, this is not at all cheap. And yet, the sooner we make investments, the lower is the cost. So there is pressure on government budgets to seek ways to stimulate, accelerate the transition. I want to take from here to a point that is related to our most recent research, which shows that what is emerging today in many countries to press for decarbonization primarily or even exclusively through subsidies is simply not affordable. Our research shows that if we go this way, debt to GDP is going to jump in the next decades 45 to 50% up. I don't think that there are countries that can absorb this. But our research also shows that if it is a combination of policies in which some public subsidies that are well targeted, mostly to R&D, mostly to do what only the public budget can do, that combination with carbon pricing, combination with more attention to raising revenues and improving quality of spending, that would increase debt levels, but only in the neighborhood of around 10%. And that takes me to my third and most important point, that we need to be very focused on this right mix of policies. I have been advised occasionally by even my own staff not to talk about carbon pricing because it's not happening enough and it is not politically popular. I'll tell you, I don't think my job is to gain popularity. My job is to speak truth to power. And the truth is that without carbon pricing, we simply will not decarbonize fast enough without this incentive that presents a predictable long-term trajectory of carbon price, not to jump today to where we should be around $75, $80 a ton by 2030, but showing the pathway to go to that place. Without it, neither businesses nor consumers would adapt fast enough to make a real difference. We also have to recognize that for general fiscal reasons and for the green transition, there has to be more determined action to raise revenues. I was just in my bilateral meetings with the Nigerian delegation. Here is a country where today tax to GDP is 8.8%. How do you run a country? Forget about the green transition. How do you run the country with such a low tax to GDP? And I give huge credit to the Nigerian government. They are determined over the next years to go from here to 18% and then eventually to 25% tax to GDP. To get there, it is paramount to write on digital transformation, because when tax administration and tax collection is put on digital footing, collection goes up, tax evasion goes down, transparency improves, and then we go to the spending side. By the way, before I go there, our analysis shows that countries can increase revenues all the way up to 8%, 8, even 9%, with one thing, aiming to be the equivalent of the top 10% performers. So just saying, okay, these people are doing great, I'm going to follow their lead over a certain period of time. And then comes the quality of spending. And there, obviously, there is room for improvement everywhere, in rich countries, in the developing world. But there is this issue of how we can provide strong data to show where the impact of investment in the transition is delivering the highest benefit. It may be in providing some security to private investors rather than making direct investments in the green transition. And I want to praise the new president of the World Bank. Ajay has come up immediately with the determination to bring top CEOs. Mark is actually helping him in that regard, to identify what would be the key to unlock more private investments, without which we cannot get to the point we have to get. I would finish with something that at the fund recently we realized we have not been doing enough, and it is attention to local currency bond markets. When they're shallow or non-existent, then domestic savings as well as non-residents savings don't make the difference they can make. So when we talk about domestic resource mobilization, very often we stop at tax collection, improvement in public administration, improvement in quality of spending, whereas we have to go that extra step. We have worked now with 11 countries on local currency bond markets. And it is amazing how much can be done, even in countries that do not yet have sufficient strength, just by improving access to information. And it is not expensive to do, but it is impactful. So data quality in everything we do, data quality is going to make a huge difference. Let me finish with one personal observation. I have been working in this area of policy for sustainability since the 80s. I wrote my PhD on environmental policy in the United States in the 80s. Why? Because I was fascinated by the bubble concept that the US applied to reduce sulfur emissions. So you put a bubble and then companies trade within this bubble, and we get least cost emission reduction as a result. When we think about carbon and carbon trade, when we think about deploying our smarts to capture the role forests, mangroves play in carbon sequestration, if we can bring that ambition, we not only are going to see an increase in revenues, but it would happen primarily in developing countries. It would happen in DRC, it would happen in Zambia, it would happen, of course, in the Amazon. How much do you have in South Africa, Leseche? Forests, mangroves. You have potential too, right? Of course. So my parting message is that there are things that we talk about, but we do not pursue with the will and determination that would make a difference. And it is time to do so. Thank you very much.
Excellent. It's a fantastic combination of data-driven urgency. So a well-grounded urgency. So I'm going to pass the floor to Governor Kanyahu Lesetja, or the floor of the podium. I'll just observe as he's walking up there that I first met Lesetja, fortunately, it's just slightly less than 30 years ago, so it's not 30 years, 29 years ago, when he was, I'll get the title slightly wrong, but Deputy Director of the South African Treasury, just at the post-apartheid moment, in charge of their debut, amongst many other things, in the international capital markets. And since that time, virtually every major economic portfolio and job inside South Africa has been his responsibility, latterly as governor of the Reserve Bank. And I can say, as Andrew and Axel and others will know, Klaus Nod, who is here, that amongst the international policy community, when you have a job to do, whether it's at the FSB, the Basel Committee, Basel, you try to convince Lesetja to do it, and it gets done. So with that, I give you the floor.
Thank you very much for those kind words, Mark. Good to be here. Yes, I've been given lots of jobs. I didn't know I would be given one on climate too. But just to share a perspective, and I will take a very South African angle. South Africa faces significant transition challenges. Our economy is highly carbon intensive, mainly driven by the use of coal-generated electricity. The transition to a low-carbon intensive economy provides opportunities, but also generates costs for particular sectors of the economy, such as coal and petroleum, and consequently, for some communities. For example, the shutting down of coal mines in one of our provinces will affect the livelihood of many households and operation of firms linked to the coal industry. Some estimates suggest that 120,000 job losses will come as a result of some of this, and the most vulnerable communities would be affected. This is significant in South Africa's context of high inequality, poverty, and structural unemployment. At the same time, the green transition provides opportunities to create new jobs and industries and tackle effectively this triple challenge. The just element requires that the transition opportunities are shared more equally while we prevent negatively impacting the livelihoods, especially of the most vulnerable. A just transition requires that benefits and costs are shared more equally within countries, but also amongst countries. Advanced economies need to honor their commitments, not only because it is just, but also because in many cases it makes economic sense. Carbon abatement costs have increased significantly in many developed economies, while they remain low in other countries. Providing funding to those countries reduces global mitigation costs. It is equally important that we improve technology transfer, which helps with accelerating global mitigation efforts. If there is one thing that the COVID-19 crisis taught us, is that global problems require coordinated global solutions. We had hardly discovered the vaccine for COVID-19, and we had been very clear that none of us will be safe unless all of us are safe. As soon as there was any inkling that the technology is available, the response from the developed countries was, our population first, and you hoarded the vaccines. In the just transition, the technology is also coming. That would save the planet and ensure that there is a just transition. If the response is going to be to hoard the technology in the developed world, just transition shall not be. We might protect our own populations, but we are in the same planet. So if the technology is not available and countries are left behind emitting, the planet will warm up, not for the countries that are emitting only. The planet will warm up for all of us. The World Bank estimates that the cost of just energy transition in South Africa is 8.5 trillion rand in net present value terms, which is in nominal terms around 180% of GDP. Approximately half of this is required for low carbon transition, which involves building less carbon intensive energy infrastructure. 2.4 trillion will be required for climate adaptation, including building smarter, more climate resilient cities and infrastructure, and developing better, less wasteful water and water management systems. The remainder of the money is for social justice initiatives that cut across both adaptation and low carbon transition. This includes, for example, social ownership projects, skills training, and other labor market activation programs that will contribute to the creation of an inclusive greater economy. Many reform projects fail, many transitions fail, because those who are losing in the short term are not taken along or compensated in some way so that they understand that there is a greater good, and in the long run we would all benefit. If we leave those people behind and they feel they are losers, then they do not have a stake in the just energy transition. They will mobilize against the just energy transition, and the public will rebel against us. And I do not think that would be in the interest of all of us. I am worried that there is a narrative that is building out there about funding in emerging and developing economies that goes something like this. There is a large pool of cash sitting idle in banks, pension funds, and multilateral development institutions that can be used to address the funding needs of these economies. The only requirements are a solid pipeline of bankable projects, a set of consistent taxonomy and disclosure rules, and new innovative financial instruments which can de-risk any economy. I think that this narrative is naive. There is no doubt that these are important factors. Consistent taxonomy and disclosure rules across economies strengthen the climate data architect, provide important information to investors, and reduce costs associated with understanding multiple different rules across jurisdictions. However, many of these rules originating in advanced economies are becoming increasingly complex, making it difficult for emerging and developing economies to comply, and hence undermining the just element of the transition. The development of new blended financing instruments is important. In South Africa, we have seen how some of these instruments can expand the overall funding envelope. For example, through guarantees to multilateral institutions to provide concessional loans. However, it is difficult to think that blended or other financial instruments can simply eliminate effects or other risks. Firstly, the risks do not disappear. They are simply shifted from one balance sheet to another. Secondly, we thought that through financial innovation, the financial sector has de-risked subprime mortgage lending in the US, only to have a major financial crisis. The great financial crisis taught us that complete de-risking is impossible and reaffirmed the view that financial innovation can be a source of major financial stability risks. As financial regulators, we need to monitor carefully and identify how financial innovation in the funding of mitigation and adaptation efforts may impact financial stability. The biggest obstacles to the just transition are the same obstacles that have prevented more inclusive growth and development in the past. Unless we go to basics, the transition is unlikely to materialize for many countries or be just. Let me highlight some of these problems. Macroeconomic stability is critical in creating an enabling investment environment. In a survey conducted by the OECD, close to 90% of global pension funds state that corruption, political risk, and macroeconomic stability are important considerations in their investment decisions, compared to 59% that identify ESG-related regulation as an important driver. The IMF's fiscal monitor and the Global Financial Stability Report highlight the deteriorating fiscal environment and the limited public funding space to support the just transition. The conclusion here is often that private funding needs to compensate for the lack of fiscal resources and do the heavy lifting. I don't think this is possible, especially if fiscal conditions deteriorate across the globe. Let me provide 3 reasons. Firstly, private funding may require some form of government guarantees, which are difficult to provide when the fiscal situation is unsustainable. Highly indebted countries cannot take on more debt, especially foreign currency denominated debt. Nobody wants to invest in countries that face high risks of a fiscal crisis or macroeconomic instability. Fiscal policy can generate crowding out effects by increasing bond yields and neutral interest rates across the globe and pushing up the cost of funding for all investment activities. Strangely, that is roughly where we are right now. The best just transition fiscal policy in the short run is to create fiscal buffers to support mitigation and adaptation investment in the medium to long run by reducing the cost of capital and deal effectively with the unintended consequences of transition activities and the disruptive impacts of physical events such as severe droughts. Limited fiscal space requires more effective use of price and non-price instruments to provide the right relative price signals for households and firms to transition while the financial sector provides funding support. The fiscal constraints, which are more binding on emerging and developing economies, have important implications for how we think about just transition in the global context. Limited fiscal space to provide expenditure support like the US has done in its Inflation Reduction Act undermines the industrial and technological benefits in these countries from transitioning. We need a more coordinated global approach that shares more equally both the benefits and the costs of transitioning. The just transition requires well-functioning social and labor market institutions to increase labor mobility and matching. The educational system needs to retrain current workers and equip new workers with the necessary skills to support and benefit from the green transition. More inclusive, just transition requires that we close the gender gap in labor markets, for example, by reducing childcare costs and increasing women's labor market participation. Government, business, and labor unions need to work closely to navigate the challenges of the transition, for example, through the establishment of social pacts. These are not only requirements for green transition, but they are also requirements for other large structural changes, for example, those that will be driven by advances in artificial intelligence. Another important area is eliminating regulatory obstacles to growth. We have seen an enormous growth in renewable generation in South Africa. Power producers are required to set up community trusts so that people living in these areas adjacent to power plants can share the revenues from generating electricity. Government guarantees have played an important role in supporting the renewable sector, but the main driver behind the current boom in renewables investment is linked to eliminating unnecessary licensing requirements. This example highlights the interaction of different policy areas to unlock growth constraints and ensure the benefits of stronger growth are shared more equally. And let me conclude by saying there are many other important areas, such as increasing overall competition in the economy, reducing housing and transportation costs, tackling corruption, developing financial markets, and encouraging skilled immigration. Funding is an important constraint to growth for many economies, but this constraint often reflects other fundamental obstacles to growth. It is unrealistic to believe that we can address these by developing sophisticated financial instruments. If we are serious about a global just transition, we need to tackle these fundamental obstacles to growth first.
Excellent. Thank you very much, Governor. Thank you again, Managing Director. What I was going to do is I'm going to lean on some pictures here to keep your attention. Then we'll have time for a couple of quick questions. And I'm going to spend a few moments on this subject of how markets and governments work together for a just transition. I want to start by acknowledging that one of the consequences, building on a point that Andrew made earlier about the shifting in trend growth, and he referenced, of course, what it has been in the advanced economies. This is a point the Managing Director has made, the IMF has made, that has had a material impact on the outlook. And I'm going to make a bit of a case that one of the ways to help get back some of that trend is going to be through addressing the climate transition. And I'd say maybe at the outset that I'm in a position now where I have little doubt that we'll get to net zero over time. The question whether we all get together, get there in time. And part of that confidence comes from what, on paper at least, is a commitment to net zero. I said I had pictures. I actually don't have pictures, but I do have pictures, but you can't see them. That's going to be the reality. But on paper, at least, we're in a position where we've moved a bit ahead. Yeah, there we go. Anyways, I'm going to just go through my remarks, and we'll see if the slides catch up, which is that the scale of the commitments are considerable for net zero. This was part of the gift of Glasgow. And the consequences of that are that there is an increasing focus on the value creation that comes here. I'm going to get to some of the points that Lasecha raised in a moment. And that we're moving into an inflection point in clean energy investment. And it's hard when you're in an inflection point to have a sense of just the scale of what's happening. 5 years ago, $500 billion a year spent worldwide in clean energy investment. For reference, fossil fuel, conventional energy investments about $800 to $900 billion a year. Last year, 1.2 trillion. This slide is actually out of date. The estimate was 1.7 trillion for this year. It's actually 1.8 now. So it's growing at the rate of 50% a year. That momentum is driving investment in manufacturing capacity. We actually have for solar and storage, the manufacturing capacity the world needs for the build out to 2030. There's more to be done elsewhere in wind and hydrogen, but we have another 7 years to do that. And very importantly, and this is a crucial point, at least in advanced developed markets, low carbon is becoming a driver of valuation and competitiveness. And so if you look at companies and valuation premiums within sectors, so this isn't a tech company versus a metal basher, but within sector, the valuation premium, which a few years ago was about 4%, scaled up to 10%. But then when we start to move post-Glasgow and we get the disclosure and the ability to make these judgments, north of a 20% valuation premium. And of course, that's driving investment. So that's the end of the good news. Now let me get into some of the challenges. One is, which the IMF has highlighted, that there's still a gap between country commitments and their underlying policies. So the commitments are now consistent, you'll see in the lower green line, with 1.7 degrees. If everyone lives up to the pace at which they say, and the policies have improved, coming down by a full degree of warming since Paris. So going into Paris, we were headed to 3.5 degrees. Now it's 2.5. The IEA's out actually last week saying 2.4. But there's still a gap. And one of the questions is one of my key points, and one of the points the Managing Director makes to finance ministers and others is, do you have credibility in closing that gap within your country? The more credibility you have, paradoxically, the less you have to do. It's a lesson from monetary policy. The more credibility you have, the less you have to do, and I'll draw that out. And then crucial point, next point, this is the biggest, in many respects, the biggest challenge, which there is a huge shortfall in cross-border climate finance available to emerging and developing economies. excluding China, and that's a big exclusion, it's $1 trillion a year by the end of the decade, and the needs for adaptation resilience at least as large, and this is from a report just out, Singh Summers for the G20. The scale of that, and I think, Lisette, a point you were implicitly making, the scale of the concessional component of that, the concessional component, so it's not a fancy instrument, but it's really internalizing some of the externalities, about a third, so $300 billion a year. So big numbers, necessary, not sufficient conditions. I just want to, though, before I get to the financial elements and then open it up, just want to underscore a few of the channels by which this process is going to drive growth. First, and at its core, this is an investment boom. The requirements for the energy transition globally add up to an incremental investment of about 2 percentage points of GDP. And that would bring the debt to GDP, or sorry, the investment to GDP ratio back to the levels in the 1990s. So it's not unprecedented, it's something we've done before, but it's a big move, and as it moves forward, obviously upward pressure on equilibrium interest rates. The other channels, which I won't go through in detail, effectively are issues around energy efficiency, demand management, addressing some of the choke points in developing these technologies, and they all would help to drive productivity. Now, let me turn to the financial side and then your questions. And this is a point that every speaker made in different ways. Budget deficits are strained. The requirements of them are only going to go up. So we need different sources, and policy needs to be designed in order to bring forward that private finance. I made this point a moment ago. I'm just going to show you two pictures around it. This is a point we really owe to Secretary Yellen in that brief interregnum between being a central bank governor and a Treasury secretary. She did some research, led some research at the G30, which got across this point in detail about if you have credible policy, investors finance in anticipation of closing those gaps, those policy gaps, you create a virtuous circle, faster decarbonization, more jobs, faster growth, and crucially, and this is the next slide, it means, for example, if you have a carbon price, you don't have to do as much. If you can anticipate credibly where the carbon price is going to be, or said differently, where regulation is going to be, credibly, the market does the adjustment for you. If you just wake up one day and say, I haven't done enough, and you raise the carbon price, you got to do a lot more. And the central bankers in the room and those who follow them will see that. Now, in this, guys, and Lisette made some powerful points about the IRA, but in this context, there are advantages to the IRA because it is simple. You know exactly what you're getting if you do an investment in the U.S. in various technologies because of the IRA. It's understandable. Even someone like me can get it. It's predictable. The rules are clear. They're open-ended for the next decade. And it is transformative. The scale, and the next slide shows the actual buy-down. The higher the bar, the more the costs have come down across various technologies. The blue, the light blue, the Cambridge blue, if you will, is the IRA contribution to that. You average across those technologies, technology costs coming down by 40%, and it is across the board. So it means that now the rest of the world gets a spillover benefit from those technology costs coming down over time and economies in scale and scope, but it does create certainly some other problems. The second aspect, so credible, predictable policy is crucial. Second aspect, it has to involve the whole economy. It does no good to have blanket bans on certain industries, financing certain industries. That only promotes paper decarbonization. You have to be able to go to where the emissions are. Thirdly, to state the obvious, in a just transition, you don't shut something off before you've ramped something up, and you have to help and support the communities. Fourthly, we need to recognize, a crucial point, the time value of carbon. Net emission reduction today is exceptionally valuable. I don't care where it comes from, because it creates the time and space for technology costs to come down, for us to sort out cross-border financing in emerging economies, to help with technology transfer. And in that, guys, COP28, look for and demand, I would say, an oil and gas deal. An oil and gas deal, this is what the COP presidency is looking to do, to achieve net zero methane and a doubling of the efficiency of the production and distribution of oil and gas. Now, on one hand, you can sit there and say, well, we shouldn't have any oil and gas, et cetera. We have an oil and gas industry. If the COP presidency achieves that, and it's a 2030 objective, that is 10% of global emissions that get taken off the table in the next 7 years. And it's possible they'll achieve it. They certainly, to their credit, are looking for it. And in the same vein, and the managing director made this point, now is the time to quit messing around, to grasp the nettle on voluntary carbon markets. These are potentially enormous transfers from the wealthiest companies in the world to projects that would be exclusively in the emerging and developing world. Nature-based solutions, but also decarbonization. A major source of capital flow, think $100 to $150 billion a year. Bill Winters is here. He's helped lead. Many others have contributed to the standards on both supply and demand integrity. I won't go into detail. Bill will be available after to answer any questions. Yes, but these standards have been developed, and they've been developed through a stakeholder process, and we just need, as a system, to decide. And then the last point, which is a real challenge, we know this is a challenge in all industries, is the need for an open trading and financial system so we get the flows there. Let me just say a couple of words on the financial side, then I will stop. We had an industrial revolution. We had an entirely new financial system that funded that. We had a new monetary system with the gold standard for cross-border capital flows. We had fractional reserve banking, a change to the role of the Bank of England and others, which created the capital. We need something, and we're in the middle of something on that order of magnitude with the financial system. We need to track carbon. We need to have transition plans, central banks and supervisors through the NGFS, and our hosts are, of course, members as well as the Bank of England and the ECB, leaders of this. You have to be able to manage the related risks and seize the opportunities. The foundation of transition finance is climate disclosure. Let me just make one point on climate disclosure. 2 years ago at Glasgow, Andrew Weir and many others were on stage, managing director, for the launch of the ISSB as a concept. They have delivered in less than 2 years the final standards for climate disclosure. As of next year, with the IOSCO endorsement, 130,000 companies will be subject to this disclosure standard. And then above and beyond, in the US, California has just passed legislation which covers thousands of companies that are active in California, Scope 1, Scope 2, Scope 3 disclosure. So the basis of the information is coming. What you layer on top of that is transition planning. We need to have a common approach. That's moving forward. GFANZ has provided a lot of work on this. We have a current consultation out around this. Key point is it's not just the easy bit, the climate solutions, but it's going to where the emissions are, it's aligning, it's managed phase out. And a part of our consultation that's currently outstanding is around expected emission reduction. So in other words, if you're financing a company, you're financing a project, what's going to happen to emissions, and that's complementary there. I would just underscore here, it's early days relative to, for example, to climate disclosure, but we're seeing the same dynamic. In other words, the authorities putting in place stronger encouragement for transition planning. So the U.S. Secretary Yellen put in place Treasury principles for net zero finance based on GFANZ. The UK Transition Plan Task Force, mandatory transition plans in the UK, came out this week, building off of GFANZ, and growing a number of other jurisdictions. And you will see over the course of this year, there already some of them are out, 200 major financial institutions with transition plans. Last words. On this crucial issue that and it's one element of a broader set of issues. We've been locked in a paradox of prudence where individual financial institutions, including multilateral development banks, have been individually prudent, sound, but collectively foolish because we have not been catalyzing the scale of finance that's required. And so this needs a wholesale change. I'd say the objective of the lab, and really the objective is down to the shareholders to make this determination, but for the World Bank, is that they use all of their capacities, operational, technical, and yes, financial, to do this, which is to maximize the total financing to address climate change and the other sustainable development goals. Total financing maximized. So if the World Bank can do that through project preparation, if it can do it through taxonomies that work for the emerging world, because the advanced economy taxonomies I just went through are not fit for purpose for the emerging world. If it can do it with that, it can crowd in. If it can do it through supporting voluntary carbon markets, it should do that as well. And that's part of what we're doing as part of the lab, and it's a broader agenda there. I'm going to stop there. Because we have, I don't think I chaired this very well, we have time for one question. But maybe that is a question, and don't direct the question to me, direct it to our guests, and then we can have a reception. Thank you very much. So if anyone wants to lob a question in, or, central bankers take away the punch bowl, the G30 puts out the punch bowl, we can have our reception. Those of you online, I'm sorry, you will not be able to, but I think it's metaphor, or virtually you can have it. And maybe I just ask you to thank the Managing Director and Governor Kenyahu and all our speakers. Very good.